Good morning, everybody. Thank you for taking time to join us this morning. For those of you that I don't know, my name is Will Hafer. I'm a managing director in the Valuation group at Stout. So thank you for being here, particularly given the weather pattern that Florence has left overhead. So at Stout, we're nearly 500 people spread across the globe, from Asia through Europe and in the U.S. We have a focus on investment banking, valuation, and dispute advisory. I have a very simple role today, and that was just to introduce myself and the firm. I'm going to turn the discussion over to my colleague, Jesse Morton, who's going to make the panelist introductions and take it from here. So thanks again.
Yep. Thank you, Will. Thank you to all the attendees for coming to our panel discussion, and thank you, of course, to our distinguished panelists for agreeing to come and speak. Before we get started, I wanted to go over a few housekeeping items. We will be offering New York CLE credits. So for those of you who would like CLEs, please make sure you sign the CLE form when you sign in and when you sign out. We would also like for you to take an evaluation survey and make sure you also take a certificate of attendance for your own records. We do have breakfast out front. For those of you who haven't eaten, please feel free to go ahead and grab a bite to eat. And for those of you who have already eaten, as you can see, there's more than enough food, so go get seconds. There is a bathroom just outside of the cafe, right outside the second door over here. We've also provided materials at every seat. It includes an outline for the discussion, speaker bios, contact information, references to relevant cases that we'll be talking about, and it also includes a page for note-taking for the event. So if you don't have one, please let a Stout representative know, and we will make sure that we get you one. This is intended to be an interactive panel, so participation from the audience is absolutely required. And Will is going to be walking around with a microphone, so if you do have a question or compliment, of course, get his attention, and he will come over with a microphone. Save all criticisms until after the panel, and you can handle that with someone else, not one of us, because we don't want to hear it. We're also going to be doing a giveaway at the end of the panel, and it doesn't look like a whole lot of you dropped business cards off. I know that's because you were so anxious to come in and get breakfast and hear us speak. So Jen, who's over there, will be walking around. Please make sure you drop a business card. We've got a couple wonderful gifts for those lucky few winners.
It's a date with you, right?
That is the last place prize. We are also videotaping the event, so keep your comments clean. And lastly, if you have any questions after the event for any of the panelists, feel free to stick around, and we're happy to speak with you. So my name is Jesse Morton, as Will mentioned. I am with Stout. I'm a director in the Atlanta office, and I'm also the Southeast Forensic Services leader. And I specialize in working with financial institutions with fraud prevention, detection, and response, and work with a lot of hedge funds and other investment managers. To my left, we have Matt Rogers, who's also a director at Stout, and he's the National SEC and Accounting Advisory Practice Leader. He was Associate Chief Accountant at the SEC's Division of Enforcement and co-led the Financial Fraud Task Force. And he was also an Associate Director in the PCAOB's Division of Enforcement and Investigations. To his left, we have Will Coleman, who's a Director of Technology Services at the Audit, Advisory, and Tax firm of Cohen & Company. They specialize in working with clients in the alternative investments industry, and Will has a niche specialization working with clients in the cryptocurrency and digital asset space. To his left, we have Tom Friedman, who's a partner at the law firm Deckert, and he's co-chair of the Global Corporate Finance and Capital Markets Practice and co-head of the Permanent Capital Practice. To his left, we have Amit Joshi, who was kind enough to stand in for Greg, who's the CFO of Apollo Investment Corporation, who is unable to make it. But Amit, I think, is a fantastic substitute. He's the Chief Accounting Officer at Apollo Investment Corporation. And Apollo Investment Corporation is a specialty finance company that serves middle market companies. And with affiliates, they have assets under management of approximately 20 billion. They're also an affiliate of Apollo Global Management, which is an alternative investment firm with nearly 250 billion assets under management. And last but not least, all the way over there, Jamie Spayman, who's a managing director in Stout's valuation practice, and he specializes, excuse me, in providing valuation services to private equity, hedge funds, business development companies, and for other funds with complex securities. So why are we here, and why is this topic so important? Financial reporting requires that assets and liabilities must be measured at fair value, which FASB defines as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So while many assets and liabilities have readily determinable market values, some require fair value measurement to estimate the transaction price. And some examples include privately owned businesses, real estate, thinly traded securities, intellectual property, complex security instruments, including certain debt investments, pre-ICO digital assets, and actively traded post-ICO digital assets due to variances between different markets and complications with the measurement date. And fair value measurement can be performed for a variety of reasons, including financial statement reporting, litigation and shareholder disputes, trust, tax, and estate purposes, and likely most relevant for this audience for calculating a fund's net asset value. Fair value measurement can be calculated using a number of different methods and approaches and can be performed by various third parties, hopefully Stout, or internally, depending on the facts and circumstances. This panel is intended to explore those issues and discuss the regulatory impact when something goes wrong with the valuation or the valuation process. And that includes discussing specific enforcement actions related to issues with valuation. So while the focus of this panel will be related to the impact of valuation to investment funds, since many of the enforcement actions have been related to investment funds, this issue is also very applicable to public companies, especially with the recent Rio Tinto and KPMG John Morton matters, and we'll touch upon those as well. And even so, the underlying issues around valuation and the best practices around valuation are similar, whether you're discussing private funds or public companies. So with that background, let's kick off the discussion. Matt, why don't we start with you? Why don't you discuss why valuation is such an enforcement priority for regulators?
Sure, of course. Excuse me. But first, I'd like to say I used to teach at GW, and my first day of class, this is like my first day of class, none of the students would sit in the front row. So, Victor, you're my prize pupil today. So, but okay. Anyway,
that's your A right there.
You get an A. It doesn't matter. All right. So, well, let's begin with the SEC's mission. And if you go to their website, you will see that it has three main priorities. One is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. So valuations affect all these elements of the SEC's mission. And many public companies and investment companies have significant assets on their books that are based on valuations. And those valuations many of those are at fair value, like Jesse mentioned. And Those fair values are they're required to be measured when they're initially acquired, and then periodically after that, right? So an improper valuation in any asset will result in the company's financial statements to be misstated, or in causing its stock prices or NAVs, the net asset values of the investment company, to be misstated. So if any asset is overstated, which is arguably the worst of the two scenarios, right? Then investors can be harmed by overpaying or being lured in to an investment fund. Of course, that said, a company that undervalues its assets may hurt investors that sell out while the underlying company may be undervalued, and the stock price then may be correspondingly be undervalued. Accordingly, the valuation process is integral to maintaining confidence in our capital markets. So circling back to the SEC's mission, without a consistent and impartial valuation process, investors can be harmed and the capital formation process will be hindered. Accordingly, most of the assets require some periodic valuation to be performed. While I would like to think that a very high percentage of entities are trying to get it right, there are still a fair number of SEC cases that involve impropriety. So there are always a few bad eggs rooted for everybody, right? Valuing assets, which there's no readily available market, requires significant judgment. So who performs the valuation and how it is accomplished will be at the forefront of the regulators' minds. Now with that, there was a new commission that came in 2017 following changes in the executive branch of the election. And Jay Clayton became the chairman of the SEC. He announced a variety of initiatives, including a renewed focus on retail fraud, which is an effort to protect Main Street investors versus Wall Street investors. This followed actions by the SEC in 2016, and they reassigned 100 staff to the investment advisory examination unit. And those are the people who go out to and inspect and examine investment advisors and investment companies. This initiation puts a spotlight on investment advisors, hedge funds, and private equity and the like, including how the respective investments are valued. So you might see a lot more activity in that space than we have seen some more.
Sure. So, I mean, one thing I wanted to add on this, I mean, investor protection, I think when the SEC talks about its three missions, it often focuses immediately on investor protection versus the other two. And I think one of the reasons why valuation is a recurring theme of the Division of Investment Management in particular is because it actually is one of the few areas in terms of investor protection where there's significant discretion exercised by the participants in the market, namely the advisors and the funds that they manage. And so, you know, what we often hear when we're talking to the SEC, not so much the enforcement division because they tend not to talk, but the examination branch, which comes in and actively explores the activities of market participants on a regular basis. And they focus on this element of discretion. And I think that's where you see, particularly with alternative investments, where there often aren't liquid markets for some of the assets that are being acquired, you know, this focus on trying to police the exercise of ad hoc determinations and discretion is really, I think, why we see this recurring approach and focus on valuation. The other area where the SEC focuses, and a lot of you will be aware of this, is on, you know, the determination of fees by the board. And the board is mandated by the Investment Company Act and the Advisors Act to monitor and police fee levels. And again, if you think about it, this is not a market-determined exercise. There is somewhat of a nascent market evolving in terms of management fees and incentive fees that apply to different types of fund entities. But generally speaking, it's done on an ad hoc basis by different boards of directors and advisors. And so again, that becomes a focus of the regulators because they recognize that, you know, when fraud occurs, it often occurs in shadows and in places where there isn't sunlight. And these sorts of valuation determinations are kind of, not that they are, but they certainly have the potential to be an area of fraud. With that, I guess I should turn a little bit to, you know, in addition to why this is a focus of the SEC, what are the ramifications? And we talked a little bit about the fact that, you can end up with improper trading signals in the market. So obviously that's a significant element of focus for the SEC, but also the payment of fees, determination of fees, and because the inputs are typically based on assets and the income or capital gains generated by those assets, that becomes an area of focus, because if the inputs are flawed, then the market can't correct and appropriately value. And so the SEC, through a number of different avenues, tries to police that, and the PCAOB, under delegated authority from the SEC, works with the audit firms to put in place appropriate regulations to, police the activity of the monitors, in effect. That's the PCAOB's action. Just to quickly, and we'll spend a little bit more time on this later, what are the ramifications of doing things wrong? There are a number of statutes that come into play, and they'll be discussed this morning. Section 10b-5 in the 34 Act, or the Securities Exchange Act, excuse me, is a regulation that basically requires that any disclosure related to the operation of an investment fund or a regular operating company has no material misstatements or omissions. And so there's a feedback loop here from the determination of valuation and how that plays through the public disclosures, whether it's in the financial statements or the actual amounts that are being disclosed, or the discussion of the process that's being undertaken by people. So that's 10b-5. And then there's also Section 38A1, and I don't want to make this just a legal seminar, but that's basically the item that says that advisors who work with funds have to develop policies and procedures that are appropriately designed to ensure that there'll be compliance with the securities laws, and in particular the Investment Company Act. So those are kind of the two areas. There's also some other provisions in the Advisors Act that come into play about conducting your operations fairly and without committing fraud. But I think the two that we hear most often from the examination branch are 10b-5 and 38A1.
And as I mentioned in my opening, a lot of times, a lot of investments are very easy to value, but other types of investments require a lot of estimates and the application of certain accounting guidance. So Jamie, Amit, I'll let you guys draw straws in terms of who's going to take this one, but if you guys could just provide an overview of some of the accounting rules and guidance that's out there around valuation of harder to value assets.
Sure. I'll just start with a quick background on some of the accounting guidance. Jesse already mentioned ASC Topic 820, fair value measurement. That lays out the groundwork for financial reporting. What is fair value? I'm going to read the definition again because I think it's important to understand some of the elements that people look at when they're doing the fair value. So again, it's the price to be received when you sell an asset, or paid to transfer liability in an orderly transaction between market participants at the measurement date. So the three elements there: an orderly transaction. So this is not a distressed sale. This is not a fire sale, liquidation sale. It's a normal course of business, orderly transaction. It's also between market participants. So it's not related parties moving something from a fund to a fund or a friend to a friend, where we're going to do this deal and then we'll do something else on the other side. So it's unrelated parties, market participants, and then it's at the measurement date. So I think one of the issues in delivering valuations is explaining that, well, we're not going to look at when you exit the investment according to your plan of 2-3 years down the road. It's what could you do today in an orderly transaction today? So it's those elements need to kind of stay in top of mind as you look at it. So ASC 820 also lays out a hierarchy of inputs and different assets. I'm sure a lot are familiar with the level 1, 2, and 3 assets. Level 1 assets, readily marketable, publicly traded. Something on the New York Stock Exchange, for example, pretty straightforward. Level 2 assets may have some observable inputs. They may be pink sheets. They may have broker quotes, or they may have a very similar security that is on a public market. And then level 3 assets, typically no publicly traded market, unobservable inputs, You think of private equity, private debt, distressed debt as some examples. And that's where, as we've been talking about the valuation process, so the entity that's doing the fair value has to use assumptions about what other market participants would assume if they were going to do an orderly transaction. And then just to today's discussion, you might think that level one assets would be the most straightforward. You would never have any issues, but I think we get into some of the cases, you can see the fraud and the manipulation even with something that you would think would be very straightforward. Ahmed, you want to add?
Sure. I mean, what I would add is what we come across is many times beside level one, there is a thin line between level 2 and level 3, right? At times when you get broker quote, questions are raised around whether it's a level 2 versus level 3. And normally it's very important that each organization, each fund has a decent leveling policy, which clearly lays down all the scenarios based on which how you'll consider something level 2 versus level 3. For instance, normally we evaluate whether the input is available based on market transaction and is available to market participant or not. Is the input something which you obtained from outside the organization? And is the input available based on a recurring basis? So here input could be that quote, right? And then the quote should not be like one time you got multiple quote and you called it level 2. And next quarter or next year you want that quote and you don't get it, right? Which clearly is an indication that perhaps this is more thinly traded and should be level 3. So as you're evaluating level 2 and level 3 investment also, it's very important that you properly document your policies and procedures. As said, right, in some of the discussion, there has been enforcement action where you have overvalued things, right? So many funds tend to take conservative estimate and put everything as level 3. Accounting principles don't allow you either, right? So you have to make proper judgment and ensure your policies and procedure clearly lays down how you will go about identifying something as level 2 versus level 3. I would also add, right, around some of the challenges which you face in valuation, right? As you are valuing hard to value assets, right? These are illiquid names. And it's important to understand, right, what kind of assumptions goes into it. We work closely with independent valuation firms to evaluate those investments. And it's very important that as you're going through those unobservable inputs, you are evaluating what kind of changes can happen, right? I mean, the guidance ASC 820 lays down clearly around different approaches which one can take, either an income approach or a market approach or an asset-based approach. And many times for a specific valuation, we use multiple approaches. And what at times we have found is also that you are doing both the approaches, but you're not reconciling the approaches. So it's a good step to do multiple approaches, but it's also very important that you reconcile, because eventually both approaches should give you the same value, because at the end, fair value will be a one number which will go into your financial statement. So that's very important to kind of ensure that that's happening. At times, you are using in a market approach, you are using public comps, and those public comps could be much larger companies which are much bigger in size and have grown much more than what the portfolio company you are trying to value. And it's very important, again, in those scenarios, you adjust the public comp to and adjust the valuation accordingly based on that portfolio company which you are trying to value.
I just want to go back to the level one assets that Jamie was talking about there a few moments ago, because there's a case, and it's in your guides there, an audit firm named Anton Chia, and they have been they're being sued by the SEC, and the matter is being adjudicated right now. But the crux of the SEC's complaint relates to 3 audits, and all audits are really come down to a difference of opinion on how to value something or account for something versus the SEC. But the SEC did turn it into an auditor case. But one of the audit clients, the center of the matter relates to valuing a transaction in which a company bought another company using its stock, and its stock was not widely traded. I think it's a pink sheet company, but they took out, they went to the newspaper or whatever it is, saw the value and multiplied that value by the number of shares they gave them. And of course, it was really a micro-cap company, and some could argue it was a penny stock, but it wasn't trading at pennies. It was trading at about $4 or $5 a share, so it gave a very high number in terms of the valuation. So the SEC's complaint is that they shouldn't have done that. It was an inactive market. So I was wondering, Jamie, if you can shed light on more on why that's not right, or is it right or wrong? Maybe not that instance, but how do you look at whether, because L1 assets, level 1 assets, right? It's market prices in an active market. So how does that work in practice?
Yeah, so I think Amit touched on it a little bit, that there's a line between level 2 and level 3, and when you get to something that you think might be level 1, things change, right? A company could go out of favor, trading should start to thin out, so you start to get stale prices that aren't traded on from day to day, and that's where your valuation policy needs to step in and say, this is how we're going to evaluate our quotes, and over a period, month to month, quarter to quarter, whatever it is, perhaps that asset starts as a level 1 asset, moves down to level 2, and then maybe even ultimately level 3. So your valuation policy needs to be written in order to handle situations like that, where you can evaluate period to period whether this asset should continue to be marked in the same way, or do we need to make an adjustment because X, Y, and Z changed.
Yeah, are there some parameters you look to see, whether something is actively or not actively traded? I mean, where do you draw that line, or how do you figure that out? Is there like a step-by-step method?
Not really step-by-step. I think it's firm by firm. Some firms will look at broker quotes, and they'll say, well, if we get 3 broker quotes, that's good. If they're all recent, that works for us. Other firms would say, well, we want to have 5.
Yeah, I mean, and to that I would add, right? I mean, again, one or two things which I mentioned earlier, right? It's also, are you getting those broker quotes consistently or not, right? Because one quarter you might get 3, and another quarter you might get 1, and it might start. It's something which you should evaluate at that point, that is it something which is broadly traded or not. And then it also depends on those brokers, right? Some of the things which we evaluate is are those brokers giving you the size, right? Is this the quote where they will do trade with you or not? Or is it just an indication based on their relationship with the deal team that they provided you a quote, but if you want to go and transact with them at that price, they're not willing to do that transactions with you. So size also at times becomes important. Then some of it is also, these days you get a lot of feeds from pricing vendors. And as you look at like some of the pricing vendor, for instance, like Market Partners, you can also get depth from them, right? Like okay, if they gave you a quote, they might have got it from 5, 6 different sources. And many of them actually also have a rating system, which kind of gives you an idea about how meaningful or how strong this quote is. So again, these are the factors which perhaps you should consider. But again, it goes back to valuation policy, which some of it which we'll discuss at a later point, that as you are drafting your valuation policy, you should consider all these factors. You should lay it down. And again, valuation policy is not something which you do it day 1 of the fund and then it's somewhere lying in your hard drive somewhere. It's something which you should keep evaluating because we are in a dynamic world where things keep on changing. So it's very important that you keep revisiting it based on as new scenarios coming up.
And also there's a really good interesting case to read because it has a bunch of different issues. But there's a SEC case, Visium Asset Management, where the asset manager was actually getting broker quotes. It was a level 1 asset, technically speaking. It was an openly traded asset, but it was thinly traded. And the traders were getting 3 broker quotes. And what they were doing was actually giving kickbacks to the brokers. Well, what they were doing was essentially telling the brokers what they wanted the broker quote to be. And it ended up resulting in an enforcement action. And there was all sorts of issues. But the case also sticks out of my mind, and you can tell I have a 9-year-old daughter because one of the defendants' name was Lumiere from Beauty of the Beast. So, I mean, it wasn't actually Beauty of the Beast, but the name.
But that was
Yes.
Jesse, I had one comment on that, which was interesting from looking at it from the audit perspective. And you always try to come up with these metrics, right? So we're not actually trying to create a valuation policy, but we have to come up with sort of an independent perspective on it. And one of the things that we've looked at in the past is to look at as a sort of a turnover ratio. What's the amount of the asset outstanding, and given a period of time, how much of that asset is traded? Is it 1% of that asset that's traded over the course of the year? That's probably pretty thin. If it's 50%, or if you turn the entire asset, the entire value of the asset over, every 6 months, that's obviously a pretty liquid asset, and it's moving around a lot. And so we'll look at ratios like that, and then changes in those ratios. If that ratio is decreasing or increasing, kind of gives you an idea of whether or not the market is getting thinner or more liquid.
I would just note that that's an area that really is focused on the time in the market. So, in 2008, 2009, there was a period of time when a number of previously liquid assets, like auction rate preferred securities, suddenly became illiquid. And so this left, a lot of firms that were actively holding and trading in these instruments at a loss as to what to value them at. And initially, the SEC gave some guidance, which I think they would now back away from, that if there's no liquid market and no bid, you value it at 0. I think they have subsequently realized that what you should do is actually look at it and move it down the continuum to a level 3 type asset and make an appropriate evaluation. But, in the stress of the moment, some of the guidance that the regulators were putting out was frankly, fraught with peril and the sort of thing that can excite hysteria in the markets when you suddenly are marking, a fairly liquid portfolio of assets to 0 in the middle of a steep downturn. That's probably not helpful. But
that's why they changed the language, right?
You were probably there.
To
so
orderly.
I
I remember all this. Yeah, I lived through some of that. Yeah, that's why they changed that language.
That's right.
To orderly
and I think
versus,
another area where the SEC has moved around a little bit, and there is learning that goes on back and forth between the industry and the regulators, is in the level 1 assets. There were a couple of speeches given. I think David Graham, who was the director at one point, gave a speech about valuing level 1 assets, and suggested that it was an obligation of the board to determine how the exchanges determine closing prices. And I think they've somewhat moved away from that, realizing that that's probably not the highest and best use of the director's time, trying to understand how New York Stock Exchange, for instance, determines an average daily or the closing trading price of a highly liquid security, right? They focus their efforts, and I think they expect industry to focus its efforts on, valuing the difficult to value items and trusting in the markets for the really liquid security. I don't know if you would disagree with that.
No. I mean, you got to use the best information available you have and make your best judgments. And the board has to make that final decision.
And the advice we give, and I'm sure that frankly all the people up here would agree that the highest and best use of the third-party valuation agents and the board audit committee of the board is focused on the difficult to value assets, and not spending an inordinate amount of time talking about the very few assets in one of these alternative portfolios that happens to be traded on the New York Stock Exchange or NASDAQ.
Yeah, and even with level 1 assets, especially for larger funds, you run into issues with, for example, control premiums and how much more that is worth than the quoted price. But I do want to shift a little bit, and before I shift the conversation a little bit, I just want to remind everyone that Will back there looks awfully bored, and please flag him if you have any questions. So, I want to see him moving around and get some interaction with you all.
If anybody has questions, raise your hand.
Yeah. So I do want to shift from an area where there is guidance that we've talked about, even though there is some subjectivity, to an area where there is essentially almost 100% subjectivity, and that's around digital assets. So I'll start with Will, since he's the digital assets expert. And Will, if you could kind of give an overview of some of the issues around cryptocurrency and digital assets and the valuations, and certainly in a time where cryptocurrency and digital asset funds are popping up probably way too frequently.
Yeah, so to sort of give it a perspective, I think we're currently auditing 120, 130 dedicated crypto asset funds, and then have some other funds that have some incidental exposure. So this is something that we deal with on a pretty regular basis. Digital assets are definitely very difficult to value, and in fact, that's sort of how our firm got started a relationship with Stout, and started talking. Jesse and I got into some conversations at various conferences. But we were just talking about, the close of business price, the end of day price. So you have a market that runs 24/7, 365 days a year. What exactly is your closing price? Which time zone? You can use 12 midnight UTC, which is what a lot of the folks tend to use. But that's interesting because that's obviously, there are some markets that are still open and actively trading right at that moment. And you're talking about a super volatile asset that can move 5%, 10% in a day. So an hour can be material. So there's been a lot of arguments about maybe the last midnight on the planet. I think it's kind of in between some emerging markets opening and closing, and maybe it's a convenient time, but maybe the data isn't available right at that moment. So that's just an interesting one that we don't typically think about. From a gap perspective, we end up with a discussion of sort of like what is your primary market. And that's really interesting because what we refer to as exchanges in the cryptocurrency world are not what we refer to as exchanges typically in the U.S. The U.S. exchange is a regulated entity. It's one that is appropriate for providing price quotes, right? In this space, you're dealing with entities that may be run primarily by tech folks out of a trader, out of a data center someplace that don't really have a heavy background in securities market, things like that. So you're very likely to get a very different perspective. And you're also dealing with people who may or may not have access to the fiat market. So you can trade on these, I'm not picking on anybody by this, but I'll use Binance. And you're on Binance or you're on Bitrex, and these are exchanges, large exchanges in the space, but they do not deal with any government currency at all. So you can get a price there, but it has to be indirect, right? You have to interpret what that price is by going out and finding another agency getting a deal in that currency. So it's sort of like you have to do a translation to get to whatever fiat value. And there may, in fact, not be any fiat access to a particular asset that you are trading in. At least not if your fund is not $1 million, you could very easily be in an asset that you can't find a U.S. source would trade directly for U.S. dollars. So then you have a situation where you have to translate values, which is interesting because the intermediary value then becomes its own model to determine what that should be. VWAP is very, very common. Issues of volume weighted average is probably the most commonly seen methodology. It seems to avoid a lot of the issues. That gets difficult because there is some argument that some of the volumes are inflated on some of the things that are not appropriately reported. So you become whether or not you need to adjust for that. The key here is, and Jesse and I talked about this at some length, is to make sure that if you have a fund that is, has any exposure to this, that your valuation policy is written to cover a lot of these various issues. and is written in a way that gives the fund manager a little bit of discretion to be able to deal with this. If there is an aberration in the market, in the nascent market, and very often there is aberration in pricing, which is something that's reported oddly for some reason. It's clearly an inaccurate price, but you make that call sometimes. The important thing here is to be consistent. If you start cherry picking, then the regulators come in and they start saying, well, why did you use this methodology on this day and then this methodology on this day? They tend to be very sensitive on certain days it makes your energy work higher or your performance work higher because you're just about ready to put your valuation or what have you. So it's very important to be extremely consistent and very clear communication. There are a lot of other nuanced issues that I want to
Well,
especially if that inconsistency gets a higher price every time, coincidentally.
Well, yeah, it's exactly that. And there's also, and I've had this discussion with the SEC on a number of occasions, that one of the assumptions is that you should generally use the best price, what is most advantageous. There's an oddity in this market where very often you have arbitrage opportunities that are extraordinarily high. And there's a reason for those arbitrage opportunities. They're not just baseless. An example would be when Korean ARB was 80% over US. That's obviously pretty substantial, and the reason for that is you could not move the money back out of the Korean exchange. So you could make the trade, and you had the value was there, but you couldn't move it. So if you went back to a fiat currency, it was stuck. And so then you took the risk of having to wait until it was possible to move that fiat currency out of the exchange, which you may never get. So just because that was the best price doesn't mean it was actually the price that was. And even if you could execute on the price, it doesn't mean you could generate all your proceeds. So there are some other issues to get in.
And Will, to your point, I mean, at least in my experience, and I think Matt and Tom would agree, is that the regulators are not necessarily looking for people who want to do the right thing and are trying to do the right thing and are following their policies and procedures to the best of their ability, and certainly in an area that is really greenfield right now. I mean, right now, if you look at the SEC actions, headlines say, 80% of cryptocurrencies are frauds. That's what the regulators are going after. They're going after the outright frauds. And last week, there was the first action that wasn't necessarily completely fraudulent. It related to an unregistered broker-dealer and an unregistered fund. But there are so many frauds out there, and people who are intentionally manipulating their NAVs, their financial statements, that really the people who are trying to do the right thing, the regulators, they don't have the time or the energy to do that. So
yeah, I guess I'd say, that's exactly right. The challenge the regulators have is they don't know they can't tell which ones are doing the right thing and in good faith. Mm-hmm. So that's why they'll be investigating entities or individuals that shouldn't have a problem, and they'll investigating individuals that should have a problem. I think one of the key takeaways, and they've mentioned a lot of times, is policies and procedures, consistency, and documentation. And we'll continue that theme as we go forward.
Yeah, absolutely. And before we move from digital assets, I mean, any insights, Jamie, Will, and anyone else on, in terms of just guidance that's out there that's maybe not necessarily directly for digital assets, but maybe analogous that folks can follow for valuing certain digital assets, especially when it comes to pre-ICO tokens and some of the assets that have the issues that Will raised?
I have one or two other quick things. There's another gotcha area, which is that you end up with illiquid assets with SaaS and safes and these sorts of things that are not actually actively traded, which are promissory notes for future tokens. And these can be extraordinarily difficult to value, and we have issues where we've had an issue where an entity has invested in another entity, that entity's funds were locked up in a technical problem. It's literally a computer technical issue where the fund were suddenly illiquid, and there was questions of whether or not they would come with it again, and then that affects the startup or the ability of that to launch, and that makes it very, very complicated to figure out how to evaluate. And this is going to sound a little self-serving and it's not. From an auditor's perspective, we can opine on whether or not the valuation methodology is reasonable and it seems to be fair risk-taking and that sort of thing. It is very important when we get into that space to get expertise, like Stout, again, not, it seems a little self-serving, I say it, but it's
feel
really,
free.
but it's really true, because otherwise you're putting your auditor in a very, very difficult position where they're trying to advise you, and then they're going to opine on whether that advice is useful or appropriate. And the regulators are going to see that as a little bit questionable. If you say, if you want to prove that you're trying to do the right thing, and say, well, we went to a third party, an independent party, and asked them for valuation. And then we went to our auditors and they said, well, did this third party actually give us a reasonable and appropriate valuation? That puts a lot more people in the boat with you, and it makes it much easier to have a discussion and prove them reasonable.
Yeah, in terms of guidance, there's certainly not much out there, and we talked about the volatility. So values are going to be up and down. I think at this point, almost every instance is a case-by-case basis. So every valuation has different facts and circumstances, and they're probably going to change within the hour, right? So, from a valuation perspective, you kind of go all the way back to basic principles. Can we use an income approach? Can we use a market approach? Is a cost approach the most reliable and supportable valuation here? So,
I would actually say, yeah. I mean, at the very first principle, I mean, you develop policies and procedures that are reasonably designed. And I think in the Bitcoin area or the blockchain area, you're really pushing the envelope about what it means to be reasonably designed. There's no geographic nexus. There's no no physical market. There's no time. So hard to find. But I think that if you document things properly, but more importantly, you spend a lot of time thinking about what is reasonable and do the best you can. And then, make sure, by the way, that you consult with the board of directors, because one thing we've discovered over the years is when there's a regulatory event, it's much better to have inoculated yourself by talking to the people who oversee you, whether that's your audit firm or your board of directors, rather than making determinations that seem reasonable at the time, could in hindsight be viewed as self-serving and not having consulted and obtained approval along the way from somebody who is objective or reasonably objective.
And then I would just add last thing, right? I mean, once you document it, just ensure you're applying it consistently, right? I mean, that's a regular theme all across, whether with digital asset or with any other asset. It's one thing where if regulators or auditors step in and they see that you are following your policy, but there are nuances where you have not followed it consistently, that's also a red flag. So beside documentation, that's another important thing.
And Amit, it's almost like you had an outline in front of you, because it's a perfect segue for your next question. And that is if you could discuss some common internal controls, policies, procedures, best practices around valuation generally. And I'll let you start, and anyone else feel free to chime in as well.
Sure. So some of the things which we have already discussed, right? So one of the most important aspects is to come up with a valuation policy. And personally, I think people should spend a good amount of time as you're drafting your valuation policy that you think through about your business. Each business is different. The kind of products which a fund deals in fund A versus fund B is different. So one should think about the kind of products you'll be dealing with, whether your investment valuation is quarterly versus annually, what kind of investments are you doing? Are these liquid versus illiquid? So once you evaluate all these things, your valuation policy should clearly state out all the things that are there. Like, for instance, we touched upon exchange-traded investments, right? When you think about exchange-traded investment, it seems simple enough, but again, we have heard, we have seen enforcement action even with exchange-traded stuff. So maybe your valuation policy should clearly state that you'll be using the last closing price. But again, if the last closing price is not available, it should perhaps state that you'll use the traded price. What if the traded price is not available? Then maybe you'll be using a min of bid and ask. But your valuation policy should be that detailed enough that it lays out all the criteria and scenarios. And then again, something which I've said, ensure that you're following it consistently. It should lay out scenarios around broker quotes, right? If you get multiple broker quotes, this is how you'll approach it. If you get single quote, maybe you'll rely on single quote, but you might have to look at a pricing vendor. If you don't have a pricing vendor, maybe you'll go to an independent third-party valuation firm and do some kind of a positive assurance or full-fledged valuation. Again, in those scenarios, it's also very important that you are working, like if you are a part of a finance function, you are working closely with the deal professionals to understand, is this something where the quote is available, but actually that quote is not reliable because it's a thinly traded investment. So again, as you look into those, it's very important that you evaluate what would be the right approach. When we look at the valuation policy and you bucket things between liquid and illiquid investment has a whole spectrum, right? So one of the best practices which I've seen is also creating an internal risk rating system, right? Some of the things which you have discussed is, should board be spending or the senior management be spending time more on the simpler stuff or more on the riskier stuff, right? And what we have found is many times having a internal risk rating system is helpful, right? So maybe you can risk rate investments from 1 to 5, where 5 is something which is performing much below expectation and 1 is performing much above expectation. So as you look at this watch list, it's very evident that perhaps board and the senior management should be spending more time on things which are rated 5 versus 1. Now, many organizations and funds are different. Again, one of the best practice would be to have an independent valuation function within that fund. Deal professionals are dealing with investment day in, day out, but not necessarily they are always independent because they are the ones who have made those investments, right? And we have already heard that valuation is such a key area in a fund which can not just impact the NAV of the fund, but it also has an impact on the fee which the advisor earns through incentive and management fee. So having an independent valuation arm, which is completely independent of deal team and the finance team, is important because again, these guys are the experts who deal with valuation day in, day out, and they can be involved in doing the valuation work. Now, when you are going through this process, right, and you identify things are illiquid, there's a whole step of process which one can follow, right? Generally, what I found is, again, many funds, what they do is they do all internal valuation. They don't send anything out to third party. Then there are funds which send everything out to third party valuation firms. And then there are funds which are somewhere in the middle, right? They might send maybe 20-25% every quarter, and then they rotate it over a life so that they cover all the investment. So you could be in any end of the spectrum, but what's more important is, again, I would lay it out to the risk and the kind of portfolio you are holding, right? If it's more level 3 investments, having an independent valuation is something perhaps which will give more confidence to your investors, to the board, to the senior management. Now, if I share one of the best practices, imagine, right, if you're doing an internal valuation, right? So when do you start the internal valuation, right? So based on the measurement date, now if it's quarterly valuation which you're doing, maybe the valuation should start a month before the measurement date. Again, depending on when you want to close your books and issue financials, some of the public funds have very tight timeline. So depending on whether it's a private or a public fund, one can evaluate when you want to start. But you should start as early as possible. Have an internal valuation done by portfolio team. Ensure that once they do it, there is a meeting which is held between your valuation team, the deal professional, and the finance team, right? The CFO, the CAO, and other controllers should be involved in this process. And as you are talking about the various names, you should also talk about the business, right? Valuation, to a greater extent, we talk about all the approaches, but it's also very important that valuation team and the controllers and the CFOs are understanding the business team around that investment, because that also will help you understand and drive the mark in some aspects. But once you are done with internal valuation, you might decide that almost all or a certain percentage will be shared with the third-party valuation firm. And as you share with the third-party valuation firm, ensure all the documents are shared with them. Because again, these independent valuation firms are relying on the information from you guys, right? And in some of the enforcement action, it has been that they did not get all the required information, right? So it's very important that you share all the information which you have with them so that they can independently value these investments. Now, as they are doing the independent valuation, many times they'll have conversation with the deal team, with your internal valuation team to ensure that they get an understanding around those investments. Once those discussions are held, they will share the valuation reports, which are draft valuation reports with you. And again, it's very important that you just don't take that and that's it, right? You should spend time reviewing those valuation reports. I can't tell you, there have been situations where we have found errors. And again, from the other side, these are people who are doing it. So there are humanly errors which are possible. At times they might miss certain information in the process. So it's very important that beside looking at the mathematical accuracy, you're also going through those assumptions. And if need be, you're questioning them. But once you get those valuation, you have discussion, you get those final valuation report, and then perhaps you have a valuation committee within your fund which will review those valuations. Now, what we have found many times one of the best practices is to prepare a valuation material, right? When you think about each investment, there could be in 5, 10, 15 pages, right? And perhaps the senior management or the board does not have time to go through all those. So having a summary page initially is a helpful thing because that can be something quick which perhaps senior management and board can review and can give them a guidance about how this valuation was done. And once you do that, this valuation material can include things like variances between prior quarter, current quarter, variances between internal valuation and independent valuation, and also it could include things like backtesting. I'm not sure how many funds do backtesting, but we have found that it's very helpful because backtesting is one of the ways where you can see whether the independent valuation or the value which you market versus what it eventually traded it, where they aligned or not. And if they were not aligned, perhaps a proper explanation will be helpful, not just for your senior management or board, but even if regulators or auditors walk in, that kind of gives you how strong the process is. Now, once you are done with valuation material, you share with your valuation committee with the board. Now, other thing which we have found useful is when do you have this valuation meeting with the board? Preference would be to have it as soon as possible, right? Because if the valuation of anything is changed, it will impact the entire financial statement, which can impact the timing. Now, if you are a public fund, you might have 40 days or so to report or 60 days depending on whether you're doing your Q or K. Now, within that short window, you want to ensure that your valuation gets done sooner and is approved by the board. Now, among all of this mix, you are also dealing with auditors, right? And that's one piece which you also have to ensure you take care of, right? So ensure you are communicating with them in a timely fashion. You're sharing information with them. There have been scenarios where we walk into a board meeting and auditors come in and they're like, oh, we have found an issue, right? And that's not a conversation you want to have with auditors or with your board at that point in time. So it's again very important that you ensure that your auditors are done with work, hopefully before the board meeting. I mean, we force upon that. What we do is normally we share our board material a week before the valuation meeting, and we have given our timeline to auditors. We have worked with them. They are partnered in the process to ensure that they are done with this as well before the board meeting. And generally, before even the valuation meeting is taking place, we have a discussion with the audit partner and the audit chair separately to ensure we all are at the same page. Because at the end, again, the last thing which you want to avoid is any surprises around valuation during the valuation meeting. But once you're done with valuation meeting, you discuss the issues, you ensure evaluation get approved, or if there are challenges of any kind, you take care of it much before the valuation or by the valuation meeting. And then once you're done with all that, the process becomes more seamless. But it's again very important that you're documenting all of this because both with auditors as well as with regulators, it's very important that you have documented your procedure, right? I mean, one thing which I learned, I come from an audit background, and one thing I learned on my second day was when my partner told me, if it's not documented, it's not done. And that has been helpful even in an industry space, because if auditors or the regulators walk in, if things are documented, we can evidence it that this is how we perform.
And Tom, if I could pick on you a little bit,
Please.
because I've been brought up a couple points which I think tie into one of the cases that we were discussing, and that is that Amit was talking about how important it is for the board to review the valuation process, the valuation committee getting involved and having management oversight as well. And one of the probably most important cases in the valuation space is the Morton Keegan case. And if you could talk about that a little bit and some of the
Sure.
lessons
So
learned.
what was interesting about Morgan Keegan is, as I mentioned earlier, it's important when you're thinking about your evaluation process that you involve the board as much as possible. And part of that is, they're an objective person. Part of it, they're empowered by law to oversee the fund. But part of it, quite frankly, is it's kind of inoculating the advisor who has an interest in the outcome of the valuation. So you have some evidence of oversight that can be helpful if there's a problem later. And I think one of the kind of corollaries of that is until Morgan Keegan, I won't say it's never happened, but the SEC is always a little bit wary of challenging independent directors. They view the independent directors within a fund as their allies. They've given speeches to this effect. They don't want to discourage prominent people from sitting on boards and exercising oversight, and so they are reluctant to bring enforcement actions. I think with Morgan Keegan, the fact patterns were fairly horrendous in the sense that there was evidence that the board of directors was not familiar, quite frankly, with the valuation policies and procedures that had been established by the advisor. There was evidence that there was no periodic review of the valuation policies and procedures that had been implemented, nor was there any follow-up when there were apparent deviations between valuations that were coming out of the valuation process and the policies and procedures that had in theory been established by the board. And so when you put all of those things together, I think the SEC felt that it couldn't simply bring an action against the advisor because whether or not there was complicity or not, I don't think they challenged, but they focused almost entirely on process, and they demonstrated it to the satisfaction of the court that the board had not exercised appropriate oversight in that case. And so I think that was helpful. That was a shot across the bow to boards to stay engaged. But I think then quickly the staff actually gave some speeches saying, that if the board is following the policies and procedures that it is established and conducting appropriate oversight, that should not be taken as a challenge to the role of independent directors, that independent directors need to do what they're charged with doing, but people shouldn't resign from boards en masse because of potential liability from being a director. And I don't know, Matt, you obviously were involved in this a little bit, but were you at the staff now? Oh, okay.
I think what you're saying is accurate about the board of directors, and they are definitely reluctant to bring actions against them because for what you said, they want them to sit. They want prominent people to sit on boards. So, but obviously, anytime things are so far astray from sort of a norm, the enforcement division is going to take some action and make a statement. And in this case, it does.
Yeah, I mean, I would add a couple things. We had a lot of discussions with boards after that about, real concerns by independent directors who, often have enormously high net worths, and, they're getting, $80,000, $100,000 a year to sit on this board, and they say to themselves, that's not a very good kind of bid-ask arrangement where I'm putting my entire net worth at risk potentially if I was found personally liable, and on the other hand, I'm getting a relatively small compensation for doing so. And we did spend time with them, but frankly, as I said, the SEC was outspoken in saying that this is not the routine, this is not our normal posture, but this was an extreme case. And I think that it's settled down a little bit, but that was definitely an effective shot across the bow. And all of our boards that we worked with, I think, really snapped to attention and spent more time on kicking the tires on valuation policies. We'll talk about some of that. But that definitely had the desired effect, I think, from the regulators. I wanted to touch on just a couple of things, if I may, that mentioned that one is, obviously we talk a lot about process. It's interesting when I've seen particularly the PCAOB, they tend to focus on very narrow points of internal control when they're reviewing the oversight by an audit firm. One of the things that we had a client deal with was they put together packages which went out, the same package went out to the internal advisors valuation process people. It went out to the third-party valuation agent, and it went to the audit firm, which, of course, does shadow valuations as well. And I think it was a very robust process this particular client was undertaking, and they had a top-notch audit firm that was conducting this. And the PCAOB focused in on the fact that a single person within the advisor was handling all this paper. And there was a concern that there was no internal control over the actual preparation of the packages. Not that there was a problem. They didn't demonstrate any kind of fraud or inappropriate action, but literally they looked for places where the process breaks down because a single person could make a change that would affect the entire process. So I thought that was interesting.
Yeah, it's interesting you bring that up because I was going to make the point that, because a lot of the policies and procedures that you talk about, there's a litany of things that you go through like a normal policy. And then there's always this bucket where you have this practice where you can, exercise some judgment or input some estimate. There's some sort of leeway in there to do that, and there's nothing wrong with that. And my suggestion was going to be, because my focus is always to protect clients and protect everybody in this room, is that when you have those circumstances, not only documenting it, but make sure somebody else is reviewing that and understanding what all of the options were that caused that change and why that change was made. And it's sort of on that point,
Right.
But a second level review always helps.
And obviously it's challenging depending on who you're talking about, right? Apollo, you guys have resources and, processes on processes, I suspect, like any large established institution. But, some of our clients are smaller and they have a leaner team, and trying to have, a second person look at everything obviously becomes challenging but expensive. A couple other things we've gotten on exams, CCO involvement, you mentioned it. Having the chief compliance officer involved integrally in the valuation process is something that, frankly, I don't think a lot of people do. CCOs typically come up with some sort of a legal or perhaps accounting background, but often it's legal. They're not offering substantive help on a valuation process. And so they bow back and they, kind of just read reports and just offer commentary after the fact. And the staff has, at least in one case, said that they would like to see the CCO or a representative of the CCO sitting on an internal valuation committee. So I thought that was interesting feedback. And then, one of the issues that we always get, and you touched on it, is what about the interaction back and forth? You instigate this evaluation process. You have your timeline in place. You send out a package. Back comes the result. There's an enormous delta between what the internal and external people are developing. And when is it appropriate to have communication? Does that somehow, cause the entire evaluation process to be not effective when there's communication back and forth? And what we always advise is, it's helpful that you give the objective information, perhaps, and give people time to work. But when there's dissonance, when there's a significant disagreement, I find it often arises because you folks are living every day with these credits. You know that somebody called you and said, we're not ready to do it yet, but we're thinking about delivering a redemption notice because we're going to take you out in a week, right? There's no way that Stout knows that. So you have to be a little bit open and back and forth, and I don't think that contaminates the whole process to give people some view as to what the real world facts are. I don't know if you agree.
Yeah, no, I agree with you. And that's like where you as a client should have an appreciation both with independent valuation firms and auditors that unlike you guys, they are not reading these things day in, day out, and you should share the information. And that's where I said, even if you start the process, say, for instance, a month or 45 days before the measurement date, you might get new information during that period. And as you get the information, you should ensure you communicate that to the valuation firm, because again, if you had something which perhaps could have an impact on valuation and was not shared with the valuation firm, and eventually is the valuation firm mark which has been used in the valuation, that can be an issue if somebody like an auditor or a regulator start looking into the work field. So again, it's very important that communication keeps on happening both ways, and you ensure that the most updated information is available to your independent valuation firms and the auditors.
And I do want to pause. We have a couple minutes left, but I do want to. Are there any questions from the audience before we go into our next topic? Yeah.
I was curious. I understand the need for detailed, but I was curious to your perspective as to what level of detail should be in policies versus procedures. And from an SEC enforcement perspective, how do you look at that?
You mean in terms of like volume or detail?
Yeah, because a lot of times the policies, from my experience, the policy is generally more general and gives the advisor a lot of discretion. But then, like Jamie mentioned, some firms would look for 3 broker quotes, some would look for 5. You're going to toss out an outlier. You want to document that, but you don't want to go into I wouldn't think too much detail in the actual policy.
Yeah, I agree with that. I think the policy should be a little bit higher level than the procedure. So if your policy is to get broker dealers, I don't necessarily quotes, for example. I don't know if it's necessary to say we need to get a 3 at a minimum in the policy, or you put that in the procedure. The regulator is going to look at it together anyway. So I think I would leave it up to your own judgment how you want to craft your policy and 2 procedures to make it all work. They just need to be in sync with each other. Right? One can't say something that's different than the other, otherwise they're going to have some challenges there. But I don't know if you guys.
Yeah, I was just going to say.
I agree with that. You do want to ensure that the policies are not detailed enough to the extent where it creates an issue, because again, depending on procedures, the other piece is policies are something which needs to get approved by senior management, board, and all that stuff. Procedures might not necessarily have to, right? So again, you have to think it from an admin aspect as well about how you want to go about it. But overall I agree, right, that you should evaluate to what extent you want to.
Yeah, and I think, by the way, the SEC would permit a certain amount of discretion on judgment there in terms of whether it's a policy or a procedure. And the procedure obviously is more of an implementing item. But I don't think that they're going to second guess as long as it appears to be a robust overarching process. There's no internal contradictions. And one thing that we always emphasize is that these documents are living documents. You may only go to the board, let's say annually, and talk about changes to your compliance policies and procedures, particularly policies. But you within the advisor firm need to be regularly reviewing that and making sure that what you're doing is consistent with what you've said you're doing. I think that's much more often in my experience the problems that come up in exams is there's been a gradual, natural, and nothing fraudulent, but a drift, because maybe it doesn't make sense what you had written down when you first started and you've never done it before. And nobody went back and made an adjustment. And frankly, people outside your firm won't know there's been drift, right? Your lawyers won't know that. Your auditors won't know it. It only comes up on an exam. So make sure that you have somebody charged once a year to go back and read these things, even though painful that is.
I think there's another concept here, which is sort of the instantiation of the actual procedure and also principle-based. So you can sort of have principle-based rules in your policies, and I think that's often a little more flexible because you don't generally modify that as frequently. So it's a more principle-based, the way that we get to be able to.
Yeah, and that's almost exactly how I look at it. Is with the funds that I've worked with, the methodology is almost your constitution, and then your procedures are the federal code, if you will. I mean the detailed step by step of how to do that, and that way you also don't run the risk of having to change a bunch of documents if you do have to tweak things, because everything should be in line with the overall methodology. I think we have another question back here.
Could there be any panel input on international holdings and to reflect things like either regime change or a really powerful new competitor? I think from the asset owner side, you have a sense of what that valuation is, and then how you bring it back to sort of a U.S. type reporting.
Not sure.
Yeah, I mean, certainly from a valuation standpoint, you want to see how that's going to affect your investment, whether it's it's going to affect the business as a whole, and that's going to change the trajectory of how your investment goes. I mean, I think international, domestic, it all you may have more variables on the international side in certain locations, but you got to take those all as a whole. How does it affect the business? How does that relate to the security that I hold within that business? And then, internationally, maybe you have some currency translation issues that you got to handle. But again, you're kind of going back to how does this affect the business? What's the likely impact on my repayment, my coupon, cash flows, things like that?
I mean, and I would add to that, right? We have an investment in an aviation, which is all across the globe. And to your point, we run into a situation, right? We might have a lessee in a specific country, and then due to geopolitical risk or things of those nature, right, there might be an impact to that lessee and the future payments which we might get. So in such situation now, again, our valuation policy around those assets is we do asset level discount rate. So we have an equity investment in that company, but it's actually, when we look at the cash flow, we look at the asset level cash flows, and then we apply a discount rate to the asset level. Now, as we look at that discount rate based on these factors, that discount rate might increase or decrease depending on which way is swinging. And that will eventually have an impact on the net present value and then eventually on our equity cash.
I just want to touch on one other thing. And are we responsible on that, or? Okay. So on the dissonance between what comes back from a stout and the internal valuation, that's another area of constant discussion. And to me, a certain amount of disagreement from time to time is healthy. It reflects that there's not a fix-in. You don't want to go to your board and say, Stout came in with a valuation of 100, and we came in with a valuation of 100.1, and you do the same thing with each name. That's not a good fact pattern. So occasionally you want disagreement, but I say there's nothing wrong with disagreement. It is important that the board understands that there's been disagreement, and I think that can lead to a very good and robust discussion. But if the advisor is saying this should be marked at par and Stout is saying 87 or 63, the board needs to hear that. And some boards have policies that they will always adopt the third-party valuation. Others say it's up to the board ultimately to decide, and sometimes they'll have a range, and as long as it's within the range that's appropriate, you can use the advisor. But I think the important thing is, number one, that the board establishes that policy, and number two, that the board hears about the disagreement. I don't know if you have anything on that.
No, I agree with you. I mean, we actually, in our valuation material, have a certain variance threshold. So we tend to have differences between internal and third-party valuation. And then based on certain variances exceeding a certain threshold, we'll put variance analysis and walk both through it. And board appreciate that, right? Because what you don't, and the reasons could be many, right? We might follow a different methodology versus what the independent valuation firm is using. We might have a different view about the company versus what they have. And though prior to the valuation meeting, you do discuss these things with your independent valuation firm, but having differences is fine. And laying all those differences out for your board so that they appreciate the whole process is an important aspect.
And again, self-serving, I suppose, given the Stouts conference. But I'm a strong proponent of having independent third-party valuation involvement. There are a few entities in the BDC space where I spend most of my time who do not have any third-party input. But I would have to say that it's well beyond a preponderance. I would say it's like all but a couple now have some involvement. Now, there's a range of practices between, we look at everything once a year, so you get a kind of rolling 25% per quarter sort of involvement, or, maybe it's every semi-annually, so everybody gets looked at twice a year, or every quarter in some cases, which tends to get a little expensive, but I'm sure it's great value. So I think there's a range, and I think the SEC defers to the board on the range of practice, but I do think the SEC, when I've spoken to them, one of the things that they love, in particular about the business development area, BDC practice, is that there is this independent third-party input, so you're not relying entirely on people, advisors that is, who have an interest in the outcome on the valuation. There's at least some objective criteria. And obviously the PCAOB has pushed the accounting firms to then go through it yet again, but I don't think that anyone would take the view that that in and of itself is sufficient, because the job of the accounting firms is not to come in and critique the valuation methodology. They may come in with a material weakness if it's deficient, but their job is not to interact with the board and provide pointers on how to adjust the valuation. So I think you really do need, if you wanted to be viewed as kind of best in class, you need that kind of independent output. And now I'll stop the advertising.
Yeah, the last thing you want is to, at the nth hour for the auditors to say, because you did it internally, or you did it.
It was wrong.
It's so off that.
It does happen, especially in the fact that are, we come back and say, we're not comfortable with that. We don't feel adequately reflecting somebody just curious looking at cost, which is the linear, from beginning to end. So this is what we expect the value to be in sort of direction.
I mean, I have had accounting firms, I'd be interested in your view on this. I've had accounting firms serve a very useful function in the board where they've said, we're getting feedback from the PCAOB that, bond equivalent yield analysis or something of that nature is vastly superior to what you're doing, discounted cash flows. Then they back off. Like there has been that kind of back and forth where you're getting feedback from the regulatory authority that governs you. I think that's very healthy, but you can't just rely entirely on the audit firm because they won't tell you there's a problem until it's too late really to fix it.
Yeah, and we do need to wrap it up. So
sorry.
Yeah.
You can't see it till it's done.
Yes, we don't see it until probably some period.
And it takes you some time to go through it.
So yeah, we're at time here, but a couple things. I just wanted to highlight a couple of key takeaways here. So one, as I hope we've kind of beaten to death, is as it relates to valuation, there has to be policies and procedures. We've seen, there's kind of three themes with regulatory enforcement matters. One is companies, funds don't have policies and procedures. Huge no-no. The second one is they do have policies and procedures, but they don't follow them. Again, big red flag. And third, which is probably the most recent trend, is that they have policies and procedures, they're following them, and it results in an unreasonable and unrealistic valuation. Couple best practices. One, independent oversight or involvement, whether that's independent directors or third-party valuation. We definitely want some independent party involved in the valuation process. Document. There's nothing wrong with having exceptions to your policy as long as it's reasonable, but make sure you document the rationale and again, follow the policies and procedures. So documentation. And this is a real issue. Matt and Jamie and I are working right now with a large hedge fund that just got severely criticized by the SEC during a routine examination. And in the deficiency letter, they raised 10b-5 and 17a issues, which almost never happens in a routine examination. So this is a real issue. It is a priority, enforcement priority for the SEC. And with digital assets, who knows? So we do have a couple giveaways here. I've got, being in New York, I know you guys are going to be disappointed. It's not a Make America Great Again hat, but it is a stout golf hat. So Scott Davidoff. There you go.
You have to wear it for the rest of the day.
Yes. I hopefully don't butcher this name, but Prachi Master. Yeah.
All right.
There you go. Enjoy.
Now your hair won't get wet from the rain.
And Oliver Zerbel. Must be present to win, so. Melissa Myro. You get a water cooler, unless you want the hat. All right. James Casurgis? No? Oh, Oliver. Oh, Oliver. Here you go. Congratulations. There you go. Wear it with pride. And Joe Musto? No? All right, so we need two more.
Oh boy.
You can call it out. Thank you for coming. Yeah, absolutely. And there you go. Thank you. So not only do you all get just priceless information, but some of you in hats and water coolers. And also thank you to our panelists. We have gifts for you as well. One last reminder that for those who do want CLE, make sure you sign out and get your certificate of attendance. And I also want to give a very special thanks to Jen Ballback, who was instrumental in putting this together and did a great job. So thank you very much. Sorry, also, if you guys could leave your name badges on the registration table on the way out. Thank you very much.